News. Let's get Mark Matthews of Bank Julius Baer and Company joining in with some perspective. Mark, great to have you with us here as always. Thank you very much. Appreciate your time. Is there any condition under which, a Fed cut will be deemed as negative in some way by equity markets? Near term, maybe pullback, etc. That's another matter. But say from day 2, day 3, is there anything which can go wrong? I'm just sort of inverting the question here, but go on.
Well, we're getting, obviously, a decision on the Fed funds rate tomorrow, but we're also going to be getting the new economic forecasts from the 17 Federal Reserve officials who contribute that on about every 3-month basis. And so it'll be interesting to see if their economic forecasts have changed. And there's the statement that will accompany the decision on interest rates. And of course, last but not least is the press statement and questions and answers that Jerome Powell, the chairman, will make. And so there will be a lot of data coming out and a lot of commentary, and that will be closely parsed. But interest rate cut, if we were going into a very obvious economic downturn and it was only 25 basis points, then I think you could intuit that as a bad piece of news for the market. But there's no real sign that we're going into a significant economic downturn, I don't think. And last night we had the retail sales, which were, I thought, quite decent. And so on balance, I can't see how it would be a longer term a bad thing to see interest rates come down.
Mark, hi, good morning. But on that question, 25 bips or 50 bips, I guess that's what the market is grappling with, right? Let's talk about the scenario of the larger rate cut. And if that is delivered by the Fed, will the markets like it or will they be spooked?
Right now, the futures market is actually pricing in 60 basis points tomorrow. So, of course, it's highly unusual for them to move in that kind of increment. But basically, it's expecting 50. I think there are very few people now calling for 25, given the amount of unofficial signaling that we've had from former Fed officials and articles appearing in the Wall Street Journal and the Financial Times and whatnot. So the 50 basis points is now expected. And if we only get 25, my own take would be the market would be disappointed by that. I also think that let me just say we are expecting 25 officially, but we do think that it could easily be 50, and that would not be a policy mistake. We should remember there is no meeting of the FOMC in October, so they have another 60 days to wait before their next meeting in November. So it could be either of them, but my sense is, given that 50 has been so widely factored into prices, there would be some disappointment with 25.
All right. Hi, Mark. Good morning and good to see you in. What about the Indian markets? You've been quite bullish on the Indian markets on the whole. We have trading near fresh all-time highs. Where do you see us headed from here on?
We all know the good stories in India, the strong GDP growth, the good demographics, the EPS growth is good. The market has fared very well since both the general election and the union budget. The problem is that it's just gone up too much. It's up 50% in 2 years. It's expensive. And I really don't think foreigners are going to buy it at these levels. So locals can continue to drive it up, and they may. But I think it's in need of some retracement. And I know I'm not alone in saying that. I think that's a fairly consensual view right now. So I think it needs to consolidate here because it's become too expensive.
No, got that, and I think we'll see what comes whether that will happen or not. So far, of course, the local investors have prevented that from happening, right? Any meaningful pullbacks at all. I mean, the crazy story from last night, pagers exploding in the West Asia. I mean, Mark, Chris would have greed and fear has been saying that for him still, geopolitics is the number one risk. It's not played out. And he says, well, on both fronts, Ukraine and in the Middle East, he says it's a number one risk. I don't know. I mean, do you see anything out of this from a market perspective?
Well, since the October 7 attack in Israel, of course, the situation has devolved markedly in the Middle East, but markets have gone up. And if you look back since World War II at major geopolitical events and their impact on the market, then it's clear the ones where there's no economic impact also tend not to see any stock market impact. I mean, the one I tell people, because it's sort of an incredible thing, is when John Kennedy was shot in 1963, absolutely terrible event, assassination of the President of the United States. Well, 12 months later, the stock market was up 25%. There was no economic impact. But then you have other geopolitical events. For example, the Yom Kippur War in 1973, the stock market was down 30% 12 months later because the oil price went up 3 times after that war. So if there's going to be an economic impact from this event in Lebanon, then I suspect you'll see some impact in the stock market. But for now, it appears, somewhat remarkably, the situation in the Middle East has been contained. It does not appear to be spiraling. Neither the United States nor Iran want to have a big and direct confrontation with each other.
All right. Well put. Thank you very much, Mark, for joining us and running us through your perspectives on a variety of issues. But of course, we'll touch base once again when we have that Fed decision later today. That's going to be the big sort of macro market driver.